Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Now, let us get into it. November 28, 1940, Manhattan, the Sherry Netherland Hotel. A man walks into the cloakroom, sits down, and writes 8 pages by hand to his wife. He was 63 years old. He had once been worth $100 million, equivalent to roughly $2 billion in today's money. He had been called the greatest trader who ever lived. He had made fortunes so large that J.P. Morgan personally asked him to stop short selling because the pressure was destabilizing the entire American market. At the end of those 8 pages, he wrote these words: "I am a failure. I am tired of fighting." His name was Jesse Livermore, and this episode is about why the greatest trader in history died broke, broken, and alone in a hotel cloakroom, and what that tells us about the choice every single investor eventually has to make. Because on the other side of this story is a man who wakes up at 6:45 every morning in Omaha, Nebraska, in the same house he bought in 1958 for $31,500. He reads 5 newspapers before noon. He eats breakfast at McDonald's for under $4. He drives himself. No bodyguards, no yacht, no mansion. That man is Warren Buffett, 95 years old, still compounding, still reading, and by almost every account, genuinely happy. Same market, same era. One difference that explains everything. Jesse Livermore left home at 14 with $5 and his mother's blessing. His father wanted him on the farm. She had other ideas. He walked into a Boston brokerage and got a job writing stock quotes on a chalkboard. He had a photographic memory. Within weeks, he was noticing patterns in price movement that nobody else around him could see. By 16, he had quit and was trading full-time. By 20, he had $10,000. He moved to New York, turned that $10,000 into $50,000 in 5 days, then lost it all in a single position. He went back to St. Louis, rebuilt, and returned. The pattern was established early. It would repeat for 30 years. His methodology was original for its era. He tracked price trends before technical analysis even had a name. He cut losses and let winners run at a time when most traders did the opposite. He studied human emotion and how it produced predictable patterns in price. In 1929, he identified the setup of a lifetime. He saw speculative excess that he had cataloged for decades. He went short in September, initially losing $6 million as the market kept rising. Then the crash hit. By the time the dust settled, Livermore had made $100 million. He was among the wealthiest men in America. Newspapers called him the Great Bear of Wall Street. Some blamed him personally for the depression. Death threats arrived. He hired bodyguards, and then he lost most of it within 5 years. Here is what nobody talks about. 1929 was not the first time Livermore made and lost a fortune. It was the 4th time. He had done this in 1901, in 1907, in 1917. Big win, overconfident sizing, catastrophic loss, then rebuild. The pattern repeated because the system that produced the wins also contained the exact conditions for the losses. A system that requires you to be right at the exact right moment, with the exact right size, and then to exit at the exact right time will eventually fail. Not because the trader lacks skill, because perfection cannot be sustained indefinitely under conditions of maximum pressure and maximum personal consequence. 3 marriages, all ended. Clinical depression throughout his adult life. Bodyguards, mansions that became liabilities. A spending pattern that matched the volatility of his income, and a final bankruptcy in 1934. His 4th. The man who wrote more clearly about trading psychology than almost anyone in history violated every rule he had created. That is not a failure of knowledge. It is a failure of a different kind. The kind that no trading system can protect against indefinitely. Warren Buffett did not grow up on a farm. He grew up in Omaha, son of a congressman and stockbroker, reading financial reports at age 7, filing his first tax return at 13. He applied to Harvard Business School and was rejected. He enrolled at Columbia instead and studied under Benjamin Graham, who had developed the framework of value investing after surviving the 1929 crash himself. Graham's framework was built around one idea above everything else: do not lose money permanently. Buffett did not want to time the market. He wanted to buy businesses, specifically businesses that would still be earning money in 10, 20, 40 years, purchased at a price that gave him a margin of safety if he was wrong about the future. He wanted time to be his ally rather than his enemy. He took control of Berkshire Hathaway in 1965 and began using its cash flows to acquire businesses and equity stakes. Geico, See's Candies, The Washington Post, Coca-Cola at 8 times earnings in 1988, a position he still holds today. Each acquisition followed the same same logic. Find a business with durable earnings power. Buy it at a reasonable price. Hold it for as long as the economics remain intact. Livermore needed to be right about what the market would do next Tuesday. Buffett needed to be right about whether Coca-Cola would still be selling soft drinks in 2020. The cognitive demands of those two tasks are not in the same category. Now here is where this gets interesting and uncomfortable. Look at almost every well-known trader across history, and you find the same cluster of traits. Livermore is not an outlier. He is an archetype. Traders tend to live loudly. The money arrives in spikes, and they spend in spikes. Mansions, yachts, multiple properties, multiple marriages. The lifestyle matches the volatility of the income, and the stress does not stay at the desk. It follows traders home. It sits across from them at dinner. It wakes them at 3 in the morning when a position is moving against them in Tokyo. Long-term investors tend to live quietly. The pattern is so consistent, it borders on cliché. Buffett in his Omaha house for 68 years. Charlie Munger in the same Los Angeles home for decades. Charlie Munger died in 2023 at age 99. Sir John Templeton ran one of the greatest mutual funds in history and retired to the Bahamas to think more clearly, away from Wall Street noise. Peter Lynch managed Fidelity's Magellan Fund to legendary returns and walked away at 46 to spend time with his family. He has never tried to come back. Buffett has said repeatedly that he would pay to do this work if he had to. He sleeps 8 hours a night. He describes his days as filled with reading and thinking. His business partner of 60 years described their working method as sitting and thinking for enormous amounts of time, which he noted was extremely uncommon in American business. Livermore once wrote that the money was made in the sitting and waiting, not in the constant trading. He knew this. He could not do it. Buffett built a system where the sitting and waiting was the entire job. Here is the question nobody asks when they compare these two men. What did each approach cost to execute? Livermore at his peak was worth $100 million and employed personal bodyguards. Buffett at 95 is worth over $150 billion and drives himself to McDonald's. One man's wealth required continuous perfection under continuous pressure. The other's required patience and time, which are very different psychological demands. So if the evidence is this clear, if the data points consistently toward long-term compounding as the more durable path, if the lifestyle comparison favors the investor across almost every dimension, why does almost every retail investor who enters markets for the first time gravitate toward trading? The answer is not ignorance. Most of these people have heard of Warren Buffett. Most of them know the argument for long-term investing. They choose trading anyway. And the reason is not rational. It is biological. The human brain was not built to appreciate compounding. It was built to respond to immediate feedback. A trade that opens and closes in the same day gives you a result within hours. You were right or you were wrong. The feedback loop is tight, fast, and emotionally engaging in a way that matches exactly how the brain was designed to process decisions. You act, you see the consequence, you learn. The dopamine system rewards the correct prediction. It feels like skill. Compounding does not offer any of that. You buy a business, then you wait. You check next year, and it is up modestly. You check the year after that, and it is up again. Nothing exciting happened. Nothing validated your intelligence in a visible, immediate way. The brain reads the silence as inaction, and inaction feels like failure for a mind built to hunt, solve, and respond. There is also the social dimension. A winning trade is a story you can tell. The call you made on the morning of a Fed decision that paid off by noon. It confirms to the people around you, and more importantly to yourself, that you are intelligent, decisive, and capable. It is social currency. The compounding investor has no equivalent story to tell at dinner. Nothing happened this week. The business kept earning. The position kept growing. Nobody wants to hear that. And then there is social media. Trading content is specifically designed to trigger the validation response. The screenshot of the green position, the call that played out exactly as predicted. These posts are not representative of the full experience of trading, which includes the losing positions, the sleepless nights, and the slow erosion of capital through decisions that each seemed reasonable in isolation. They present only the validation moments, because validation is what gets shared. The result is an environment where the most visible version of trading is also the most misleading one. Both Livermore and Buffett arrived at the same conclusion about why most participants fail. Livermore described the average retail speculator as someone who knew enough rules to lose money more slowly than a complete beginner, but not enough discipline to follow those rules when real money was at stake. The failure was never intellectual, it was always psychological. Buffett has said something structurally identical. Temperament matters more than intelligence in investing. The stock market is a device for transferring money from the impatient to the patient. Both men spent their career studying how human emotion produces predictable errors in markets. Livermore tried to profit from those errors in real time, which required him to maintain perfect emotional control under maximum personal pressure indefinitely. Buffett built a system that required him only to wait for other people's emotional errors to create buying opportunities, then sit still and let compounding do its work. Livermore understood the enemy. He wrote about it better than almost anyone alive, and he still could not beat it consistently. Buffett did not try to beat it. He built a system that made it irrelevant. One man wrote his final note in a hotel cloakroom and called himself a failure. The other reads newspapers at his desk in Omaha at 95 and says he would pay to do this work if he had to. This is not an argument for one path over another. It is a question only you can answer. What do you want from markets? And more importantly, what life do you want to live while you pursue it? Amateurs chase the validation of being right. Investors build systems where time does the work. Visit ProfitByFriday.com today. Subscribe free to the Friday Flash, where you will receive one stock fully evaluated through the clear framework every Friday, so that you know everything about the company before you decide to invest. No noise, no hype, just the analysis that matters. We trade for cash flow. We invest boring to build legacy. See you in the next episode. Bye for now.